Welcome to session 8, and we're going to begin this session with a review of the frequently missed questions from session 7 quiz. So the first one that we have today is question number 2. Qualified student loan interest includes interest on loans that paid for room and board, books, tuition and fees, both both B and C, or E, all of the above. And the correct answer is E, all of the above. Student loan interest will cover any interest on expenses that you paid for room and board, including books and tuition and fees. So it's a little bit different than what we'll see when we get later on into the credits and looking at education credits. Room and board is not considered a qualifying expense. Move down to question 4. With regard to moving expenses, which of the following statements is true? You can claim a moving expense deduction for the cost of moving your pet cat to your new home. You can claim the cost of moving new furniture you purchased on your way to your new home. You can claim the cost of food and accommodations on the way to your new home. Or you can claim the cost of lost security deposits because you had to get out of your lease early. Well, the correct answer is A. You can claim a moving expense if you have to move your pet cat or any other animal, and it costs you additional rather than just taking them with you in a car or something if you need to ship them. Let's look at why the others are wrong. Answer B. You can claim the cost of moving new furniture you purchased on the way to your home. No, the IRS will not let you purchase new furniture and then ship it. You can only charge, you may only claim a moving deduction for the cost of furniture you already own and ship from your old location to your new location. Answer C is wrong because it includes the cost of food. You're not allowed to take a moving expense deduction for food, but you certainly can for any accommodations that you have to pay for sleeping along the way. And D, the IRS does not allow you to claim a moving expense for a lost security deposit. Question 6, the due date for contributing to a SEP or simple IRA plan is A, the date of the return, the due date of the return, B, December 31st of the year in which the deduction is to be claimed, or C, the due date of the return including extensions. Well, for a SEP or simple IRA, you are allowed to contribute all the way up to the due date of the return, including extensions. So if you're an individual filing Form 1040, Form 1040, and you've put an extension in, you have until October 15th to contribute to your SEP or simple IRA plan for that year and still take a deduction for the contribution, an adjustment for the contribution. Question 8. Per your divorce decree, you must pay the entire mortgage payment on your home you jointly own with your ex-spouse. Your payments are A, partially deductible to you as alimony, B, fully deductible to you as alimony, C, not deductible to you as alimony. Well, the IRS says that you may split that amount in half if you jointly own the home with your ex-spouse. You will be allowed to claim half of that as an adjustment to income on your return, and the other half, you will be allowed to claim half of that as an adjustment to income for alimony paid on your return, and the other half you will be able to claim any of the mortgage interest for that half on your Schedule A. Question 9. The 2012 health insurance deduction for the self-employed is what percent of the total insurance premiums paid? Well, it is 100%. It's 100% of your self-employed health insurance premiums can be an adjustment to income on Form 1040 line 29, but that's up to the amount of net income you have from self-employment minus half of your self-employment tax. So let's say you had insurance premiums of $10,000, but your business is only showing a net income of $6,000. Your self-employment tax, to make it easy, is $100. So you'd only be allowed to claim $5,900 in health insurance an adjustment to income for health insurance of $5,900 on line 29. Now, the balance of that $10,000 certainly could be claimed on Schedule A, subject to Schedule A limitations. Okay, that's our final frequently missed question. Let's take a look at the mini problem and go through this. Lex Luthor moved to a new job on August 1st, 2012. His employer reimbursed $500 of his allowable expenses, which included the following: moving of household goods, $1,500. Yes, that's deductible. Shipping his pet cat. Yes, as we learned earlier, you can have a moving deduction for shipping your pet, $250. Storage of furniture for 5 months at $100 a month. Well, IRS rules state that you are allowed 1 month worth of furniture storage as a allowable expense for a moving deduction. So Lex is only going to be allowed $100 for 1 month of storage, even though he had to store it for 5 months. Lodging while driving to his new home, $200. Yes, perfectly acceptable. But meals while driving to the new home, nope, $100, not acceptable. So when we take a look at those expenses, and we go to prepare Lex's 3903, you answer the following questions. So Form 3903, line 1, we are going to put on $1,500 of moving of household goods, $250 for shipping the cat, and $100 of the storage. That totals $1,850, and that is what goes on line 1 of Lex Luthor's 3903.
Well, good morning, everyone, and welcome to Pacific Northwest Tax School's presentation of our course called Itemized Deductions Part 1. In today's class, we're going to be covering medical expenses, deductible taxes. Today's class will have 3 passwords. I give them randomly, but other than that, I'm done with those brief instructions, and now it's time to get on with the show. Itemized deductions can't fit into one day, so we divided it. And today we are covering medical taxes. And accompanying today's class, we do recommend you reference or read various IRS publications, including the pages you see here from Publication 17, as well as Publication 502, Medical and Dental Expenses. They're all gripping reads, if you ask me. I personally like reading IRS publications, and although some people complain that they're difficult to read, I quite frankly find them quite easy to read and loaded with useful information and aha moments where I didn't realize I knew something. Even after 20 years of doing taxes, I still routinely learn stuff I didn't know simply by reading the publications. And let's move on to the next page of our course, which is where I have what we call our introduction. And on this page, I've highlighted the portion of Schedule A that we are covering in today's class. You can see I've highlighted medical, taxes that you paid. So just as a brief introduction, you use Schedule A to figure your itemized deductions, and in most cases, your federal income tax will be less if you take the larger of your itemized deductions or your standard deduction. And if you itemize, you can take part of your medical and dental. You can also take on reimbursed employee business expenses, amounts that you paid for certain taxes, certain deductible interests, contributions to charity, and various other miscellaneous expenses. You can also deduct, if you have a casualty loss or a theft that's large enough, you can claim a deduction for those events and the loss of value in your property. Now, there are certain people who choose to itemize deductions because there's a tax benefit for it. But there are other people who have to itemize deductions. In other words, they don't really have a choice. They have to itemize. And you must itemize your deductions if either of the following are true. You are married filing separate and your spouse itemizes deductions on his or her return, or you are a non-resident alien filing Form 1040-NR. However, there is an exception for residents of India because of the specific tax treaty that the United States has with India. Indian residents are able to file 1040-NR and claim a standard deduction. But if you are a resident of any other country in the world and you are filing Form 1040-NR with the U.S., then you are not allowed a standard deduction and you must itemize your deductions. I don't have 1040-NR in front of me, but if you were to ever stop and look at it, you would observe that the Schedule A is actually built into 1040-NR, providing people the opportunity to complete that schedule without having to attach a separate page. Now, who should itemize deductions? Well, you should itemize deductions if your total itemized deductions are more than your standard deduction or you are paying the alternative minimum tax. And the reason it says you are paying the alternative minimum tax is that the alternative minimum tax actually does not allow the standard deduction. So if you don't itemize your deductions and you are required to pay alternative minimum tax, the alternative minimum tax will not allow the standard deduction that you entered on your return. And therefore, even if your itemized deductions are smaller than the standard deduction, you may still be better off using them over the standard deduction if you are required to pay the alternative minimum tax. So what are itemized deductions? Well, itemized deductions are deductions that you claim instead of your standard deduction. And you can either itemize or you can claim the standard deduction, but not both. That's different from, say, credits and adjustments to income, where if you claim an adjustment to income on the front page of your 1040, you can still claim a standard deduction. Or if you claim certain tax credits, you can still claim the standard deduction. But with regards to the standard deduction or itemized deductions, it's one or the other and never both. Itemized deductions are, of course, reported on Schedule A of the Form 1040, but you cannot itemize deductions if you are filing 1040-EZ or 1040-A. And if your itemized deductions are greater than your standard deduction, it is usually more beneficial for you to itemize. Now, there's an important rule to remember for all itemized deductions, and it's actually the case for all areas of tax law. In general, the rule is no double deducting. You must use after-tax dollars to pay the expense that you wish to claim as a deduction, and in addition, you may not claim a tax benefit for the same expense in more than one way. If you can claim an itemized deduction for an item that is also used to claim another tax benefit, you may not claim a double benefit. So in that way, you would need to actually choose. So for example, let's suppose you are taking some college courses. You're enrolled in a degree program at university. Well, if you are, you're probably going to be eligible for the tuition and fees deduction, the American Opportunity Credit, or the Lifetime Learning Credit. Any of those three are a possibility. But it's also possible that if you meet the specific requirements that allow for education to be deducted on Schedule A, that you could claim it there, but you wouldn't be able to do it in more than one way. There's 4 potential ways to claim education expense, but you can only use one of those methods for most of the different types of education expenses that you would ever try to claim. And that same rule flows through to other types of deductions, including medical benefits. And here's some examples of ways in which a tax benefit can affect you in more than one way. If you have employer-paid or pre-tax health insurance premiums through your job, obviously you cannot then turn around and claim those as a deduction on Schedule A because that gives you a double benefit. Flex spending accounts that you set up through your employer allow for a salary reduction into a flex spending account, and then you take the money from that account to pay medical expenses. Clearly, you cannot take a medical deduction on Schedule A for expenses that were paid with funds that you put into your flex spend account. Health savings accounts, the same thing. You're allowed to salary reduce into an HSA. You're allowed to make contributions to an HSA that are then deductible. Once the money is in the HSA and you pull it out, if you spend it on medical expenses, it's not taxable to you, but it's also not deductible to you. The dependent care benefit is another one. You may, in certain situations, be able to claim a dependent care credit for an individual who is receiving medical attention. And it could be that the medical attention they're receiving is deductible as a medical expense or as a dependent care expense. For example, if you have a person in the home to care for a person who's unable to care for themselves, that would be allowed as medical expense. And it's also allowed in certain situations as a dependent care expense. but you couldn't do both for the same expense. The health coverage tax credit, clearly you cannot claim that credit and then claim a deduction with the same money used to pay for the health insurance. And health insurance premiums that are deducted by a self-employed person as an adjustment to income cannot then be turned around and deducted again on Schedule A. It's one or the other. So with that brief introduction to the concept of itemized deductions, we're now going to move on to one of the bigger topics that we're going to cover today, which is medical and dental expenses. I look at medical and dental expenses as really a tax benefit that is waved in front of us, but almost as in a bait and switch type of fashion. I say bait and switch in that the lure is put out there, oh yeah, I can deduct medical expenses, but then they're taken away again by this limit, the 7.5% limit, so that very few clients ever get to benefit from claiming medical expenses as an itemized deduction, because most individuals, aside from health insurance, don't approach paying medical expenses large enough to exceed 7.5% of their income, unless it's a really bad year. Now, the exception to that general rule hits when people turn age 65. There seems to be a period of time after people retire from work and they go on Medicare that they sometimes have pretty decent medical expenses as their health is ailing and they start to have some larger bills, particularly if they end up in a nursing home. But we're going to go through a long list of things today that are deductible as medical and a few things that are not, and basically teach you the rules about what is and is not deductible as a medical expense. Medical expenses in general are defined as the cost of diagnosis, cure, mitigation, treatment, or prevention of disease, and the costs for treatments affecting any part or function of the body. So it's a pretty broad term. These expenses include payments for legal medical services rendered by physicians, surgeons, dentists, and other medical practitioners. They also include the cost of equipment, supplies, and diagnostic devices needed for these purposes. Now, very often my clients are really surprised to learn that a dentist expense is a medical expense, or that a trip to their optometrist would qualify as a medical expense. In certain situations, they might be receiving massage therapy for some medical conditions that they have, and they're surprised to learn that those are deductible. So what's interesting about medical is they do have the bait and switch. You throw out the lure of the medical expense being deductible, and then you take it away with a 7.5% limit. But once you are approaching that 7.5% limit, what you will observe is that it's a really broad category. In other words, there's a lot of stuff that's deductible. It's not nearly as restrictive as a category as, say, the education expense credits are. If you're trying to claim an education credit, you're allowed to claim the cost of tuition fees, books, supplies paid to the institution as a condition of enrollment, and under the American Opportunity Credit, a few other things as well that are required for course materials. But you're not allowed the cost of many, many other things that are inherent to education. With medical, if you're spending the money because of a medical need or because of a doctor's recommendation, odds are you will be allowed to claim it. But of course, there's still going to be some restrictions to that rule, and we're going to learn about those. Now, medical care expenses must be made primarily to alleviate or prevent a physical or mental defect or illness. They do not include expenses that are merely beneficial to general health, such as vitamins or a vacation. Medical expenses include the premiums you pay for insurance that covers the expenses of medical care and the amounts that you pay for transportation to get medical care. Medical expenses also include amounts paid for long-term care services and limited amounts paid for any long-term care insurance contract. Well, when can I deduct my medical? You can deduct medical expenses only in the year you paid for them, regardless of when the services or treatments were provided. Payment is treated as paid on the day you mail or deliver a payment by check if you made a payment by check. The date reported on your financial institution statement if you use a pay-by-phone or online account to pay your medical expenses, or the date you charged payment to your credit card if you paid by credit card. Remember that the date you actually pay the credit card bill is not relevant at all. The debt is considered paid when the charge is made. So you're at your optometrist's office and the optometrist presents you with a $400 bill. You pull out your credit card and that card is swiped. That bill is paid there and then at that minute in time. And the fact that you don't pay that credit card off until a month or two later is not relevant to the equation. Now here's a tip. If normally you would not have enough medical expenses in a single year to exceed the 7.5% rule, then you should plan to pay your expenses in the most advantageous way. And here is an example. where we've planned the payment of expense to maximize the deduction. In other words, we've tried to put more money going out in form of medical expense payments in a single year rather than spreading them over two. David's adjusted gross income is $40,000. He has scheduled a $3,200 corrective eye laser surgery for January 2013, and he has received a bill requiring advance payment for that procedure. During 2012, he also paid $2,000 of other deductible medical expenses. If David pays for his eye surgery bill in 2013 after the new year, his other 2012 medical expenses are not going to be enough to exceed that 7.5% limit. So we take $40,000, multiply that by 7.5%, and we get $3,000. However, if David pays for his corrective surgery in December 2013, his allowable medical expenses for 2012 would jump to $5,200. He will be able to claim a $2,200 medical deduction on his Schedule A because his $3,000 amount that is the limit is less than $5,200, and the difference is what he gets to deduct. If David pays the surgery by credit card in 2012, he will still be allowed a deduction for 2012 even if he does not pay the card off until 2013. Note, however, that a deduction cannot be claimed for future medical care. David's payment of that bill in December is allowable because it is the payment of a current medical expense. So the IRS does say that you can't pay today, say $10,000 today, so that you have unlimited care from your optometrist or your dentist for the next 3 years. They don't allow that. You really have to have the treatment. You have to have a medical bill associated with that treatment and pay for that treatment and not be looking off into the future for some undetermined amount of time. For 2013, we've got a bit of bad news. That 7.5% limit that is already so ridiculously high, at least in my opinion, it's about to go up. It's going to increase to 10% for filers who are under the age of 65. And so we're already in 2013 as I'm teaching this class. The class will cover 2012 law, but I felt that because 2013 has a significant change coming that I would mention it. And so when we're preparing 2013 tax returns next year, we're going to be in a situation where the medical expense for our clients is going to have to be even larger before they can begin to benefit from it. On the other hand, it's going to be real easy to do the mental math on 10%. If your income's $50,000, you're going to have to spend more than $5,000 on medical for it to matter. So it'll be a simple equation for us and our customers to remember. But however, the 10% rule applies only to those filers under age 65 because there is a temporary exemption that runs from January 1, 2013 through December 31st, 2016 for individuals who are age 65 and older and their spouses. If you or your spouse are 65 years or older or turn 65 during the year, you are allowed to deduct unreimbursed medical expenses that exceed 7.5% of your adjusted gross income. The threshold remains at 7.5% of AGI for taxpayers age 65 or older until the end of 2016. But beginning on January 1, 2017, regardless of your age, you may deduct only the amount of the total unreimbursed allowable medical care expenses for the year that exceed 10% of your adjusted gross income. Now, one of the reasons that this has come into being is because there was a funding needed to provide money for Obamacare. And so when Obamacare became law, the government is going to be helping to pitch in and pay for a certain portion of the health care expense of individuals through medical insurance. And so money had to come from somewhere to help fund that, and one of the places they went is by increasing the ceiling here. Now, interestingly, if you are subjected to the alternative minimum tax, you're only allowed under the AMT rules to deduct medical that exceeds 10% of your income anyway. So a 10% limit has been in effect on certain filers for a long time, those filers who are subjected to alternative minimum tax. Now, whose medical expenses can you deduct? You can deduct medical expenses you pay for yourself and the following individuals, provided they were paid during the year 2012. You can deduct expenses you pay for your spouse. If you are married filing separately, you can only claim expenses you paid for your spouse if you paid them after you were married. But if you are married filing joint, you can claim expenses you paid for your spouse at any time during the year, so long as you were married on the last day of the year and clearly you file a joint return. For your dependent, you're also allowed to claim medical expenses. This person who is your dependent must have been your dependent either at the time the expense was paid or at the time the medical service was provided. You do not need to claim a dependency exemption for your dependent, For purposes of the medical expense deduction, a person qualifies as your dependent if both of the following requirements are met. Number one, the person was a qualifying child or a qualifying relative, and the person was a U.S. citizen or national or a resident of the United States, Canada, or Mexico. Well, we're going back up again to some of the rules we discussed very early on in our series. Our very first session was called Filing Requirements, Filing Status, and Dependents, and we looked at who is a dependent there. And we're looking at when you fill out the exemption section of your 1040 and you claim a dependent, who are you allowed to claim? We are allowed to claim a qualifying child or a qualifying relative. But when we get over to medical expenses, you're also allowed to claim a qualifying child and a qualifying relative. However, the definition of qualifying relative is slightly different than it is for qualifying child. But for qualifying child, a qualifying child is a person who is your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, half-brother, half-sister, or a descendant of any of them, for example, your grandchild or a niece or nephew. And at the end of 2012 was under age 19 and younger than you or your spouse if filing jointly, or under age 24, a full-time student and younger than you or your spouse if filing jointly, or any age at all, so long as they were permanently and totally disabled. This person, who is your qualifying child, must have lived with you for more than half the year. This person must not have provided more than half of his or her own support for the year, and they must not file a joint return other than as a claim for a refund. With regards to an adopted child, a legally adopted child is treated as your own child, and this includes a child lawfully placed with you for legal adoption. And you can include medical expenses you pay for a child before adoption if the child qualified as your dependent when the medical services were provided or when the medical expenses were paid. So if you paid for expenses before the adoption became final and you're only allowed to claim an exemption for that child after the adoption is finalized, but you pay the expenses after the adoption is finalized, then you're allowed to still claim them. There's some special rules here for children of divorced or separated parents. There's normally a rule for medical that in order to claim a medical expense deduction for a qualifying child, you're going to need to be able to claim that child's exemption. But there is an exception in the case of divorced and separated parents. For purposes of the medical and dental expense deduction, a child of divorced or separated parents can be treated as a dependent of both parents. Each parent can include the medical expenses that he or she pays for the child, even if the other parent claims that child's dependency exemption, so long as the child is in the custody of one or both parents for more than half the year. The child receives over half of his or her support during the year from the parents, and the child's parents are divorced or legally separated under a decree of divorce or separate maintenance, are divorced under a written separation agreement, or lived apart at all times during the last 6 months of the year. But this does not apply if the exemption is being claimed under a multiple support agreement. So what this is essentially saying here is most of the time when medical expenses are paid, if you've got a parent of a child paying a medical expense and then the grandparent comes in and says, hey, I know you need some help for paying this child's medical expenses, I'm going to help pay them for you. That grandparent would not be able to claim the medical expenses for the child because that grandparent is not entitled to the exemption of the child. But with the case of divorced and separated parents, even if the child is in the custody of one parent and that parent is able to claim their dependency exemption and any other tax benefits associated with the child, if the other parent, the separated parent, comes along and pays some of those expenses, that other parent will still be allowed to claim them on his or her Schedule A. The other category of dependent for whom you can claim medical expenses is the qualifying relative category. And the rule for qualifying relative, or the definition of qualifying relative for purposes of medical expense, is slightly different than the rule for claiming a qualifying relative as a dependent. In other words, can you claim that dependency exemption on the front page of your tax return? You don't need to be able to claim the exemption on the front page of your tax return to still have a qualifying relative for medical expenses. So as I'm reading through this, if you can think of what test is missing, you can just chat it to me. So for purposes of medical expenses, a qualifying relative is a person who is your son, daughter, stepchild, foster child, or a descendant of any of them, for example, your grandchild, or a brother, sister, half-brother, half-sister, or a son or daughter of either of them, again, a niece or nephew, or a father, mother, or an ancestor or sibling of any of them, for example, your grandmother, grandfather, aunt, or uncle. a stepbrother, stepsister, stepfather, stepmother, son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, or sister-in-law, or any other person other than your spouse who lived with you at all times of the year as a member of your household if the relationship does not violate local law. So what we're looking at here are the rules for relationship or member of household. And when we're looking at, it's kind of not even seemingly related to this category, but the IRS has a table for qualifying for the filing status head of household. But that table is used in more than one way. It's used in more than just the way to determine if you qualify for head of household. It's also used when we're looking at medical expenses for the definition of a qualifying relative. Qualifying relative is a person who is related to you in such a fashion that if you could qualify for head of household, they would qualify you for that status. Or they're a person who could not qualify you for that status, but you can still claim them as a dependent because they lived with you as a member of your household for the entire year. And that would include a boyfriend, a girlfriend, a friend, an unrelated child who maybe comes to live with you and you're taking care of them. As long as they're a member of your household for the entire year and they pass all of the associated dependency tests, you can claim their dependency exemption. But when it comes to medical, you still don't need to claim their dependency exemption in some cases. So the second rule we look at under medical is that the qualifying relative cannot be the qualifying child of any other person and for whom you provide over half the support in 2012. So they have to be a citizen or resident of the United States. They have to either be related to you or they have to have lived with you for the entire year. They cannot be the qualifying child of another person, and you must have provided over half their support. There is a test here that's missing when we're looking for the rules for claiming dependency exemption. Does anyone know what that test is? There's a dependency test that we normally have to pass in order to claim a qualifying relative as a dependent, but that test is not a test for purposes of claiming medical expenses. Does anyone in attendance today know what that test is? You're all real quiet. If you know the answer, you can just send it in your chat box there. No one knows? Okay, Harvey is going to give it a go. It is the income test. Thank you. When we're looking at claiming a person as a dependent, there are more tests, and a key test is the gross income test. If that person has gross income equal to or greater than their exemption deduction, and for 2012, the exemption deduction is what, $3,800? And for 2013, it will go up, and for 2011, it was less. But every year, that exemption deduction amount is a benchmark, and if the person we want to claim as a qualifying relative has an income that is equal to or greater than that, we're not allowed to claim their dependency. But when it comes to medical, we can still claim a person as a dependent for purposes of their medical expenses, even if they fail that test. In other words, you could have your adult child living with you as a member of your household. You're providing over half of that person's support, they're related to you, but they have a job. And then they incur medical expenses and you pay those expenses for them. That job is generating enough income that they don't qualify as your dependent, but you can still claim the medical expenses. Okay, so now we're on to the next category, support claimed under a multiple support agreement. Now, every once in a while, you've got a person who's being supported, but they're not being more than 50% supported by a single person. They're being more than 50% supported by two or more other people. And when that happens, you can enter into something called a multiple support agreement, whereby the people who participate in the support, anyone who provides more than 10% of the support, is eligible to claim the deduction, but only if the others sign and release that over to them using a form called 2120. So in the case of a Form 2120, when we have a multiple support agreement, the medical expense rule is that whoever gets to claim the dependency under the multiple support agreement is the only person who can claim the medical. So if you have a situation where you've got two brothers who are both contributing towards the support of their mother, and they're both individually providing medical care expense payments for their mother, but neither of them can show that they paid more than half individually, they enter into a multiple support agreement, and one brother gets to claim that mother's expense. Only the brother who claims the mother's dependency exemption will be allowed to claim any medical expenses that he paid for his mother. And the other brother, no one can claim medical expenses paid by him. And finally, you can also claim medical expenses you paid for a decedent. If you paid medical expenses for your deceased spouse or dependent, include them as a medical expense on your Schedule A in the year they are paid, whether they are paid before or after the decedent's death. The expenses can be included if the person was your spouse or dependent either at the time the medical services were provided or at the time you paid the expenses. So what medical expenses are deductible then? Allowable expenses must be primarily to alleviate or prevent physical or mental defect or illness, such as payments for legal, medical services rendered by physicians, surgeons, dentists, and other medical practitioners, and the costs of equipment, supplies, and diagnostic devices needed for those purposes. Expenses that are merely beneficial to general health, such as vitamins or vacation, are not allowed as a deduction. As a general rule of thumb, you can claim a medical expense in the following situations. The treatment is prescribed by a doctor to address a medical need. The treatment is related to your health or a diagnosed medical condition. The treatment is not purely cosmetic and holds a valid medical benefit. For example, eye laser surgery corrects myopia and is therefore allowed, myopia being nearsightedness, and it can correct some other visual issues as well. A facelift for purely cosmetic reasons or teeth whitening is not allowable. The treatment cannot violate local law. The expenses for equipment or home improvements needed to accommodate a medical need. Health-related programs such as alcohol and drug treatment centers or stop smoking programs are allowed. You may also deduct costs associated with participating in a weight loss program. However, the cost of purchasing diet foods through a program is not deductible. So for a comparison here, we see two real key leading companies that advertise themselves or that are in our face a lot. One of them is Weight Watchers, and another program is Jenny Craig. And they're very different. Weight Watchers is more education-based. They have you attend meetings, they provide cookbooks, they provide advice and encouragement on how to change your dietary habits to lose weight and maintain a healthy weight. We compare that with Jenny Craig. With Jenny Craig, you pay a small monthly fee, but by and large their profits are made because they sell you foods that are all nutritionally balanced with a certain calorie count in them. And if you participate in their program, you're buying all their food. And the IRS says that you would be able to deduct the monthly fee that you pay to Jenny Craig, but not the food that you buy from Jenny Craig in most cases. And of course, with Weight Watchers, the membership fees and the fees to attend the meetings, that is allowed. Insurance premiums are the next thing that are allowable. You can deduct out-of-pocket amounts that you pay for medical insurance premiums, including premiums paid with after-tax dollars that cover hospital care, surgery, etc., prescription drugs, dental care, contact lenses and glasses, group or co-op care, long-term care, and you can also deduct Medicare B and D. So if you have a client that they come in and they've got that Social Security statement and it shows the Medicare B or D premiums being held out of their Social Security coverage, that's an allowable medical deduction. It should automatically be entered on the Schedule A. Now, our software, if you enter the 1099 SSA that is issued by the Social Security Administration, there's a box where you can enter that Medicare premiums were paid, and the software will automatically carry that to Schedule A. But if your software doesn't do that, then you would want to make sure you're manually entering it and not missing out on that deduction because it's pretty substantial. Self-employed health insurance premiums. If you had a net profit from self-employment and neither you nor your spouse was eligible to participate in a subsidized employer-provided plan during the year, you can claim up to 100% of the cost of your health insurance premiums as an adjustment to income on Form 1040, line 29. That is assuming, of course, you have a profit, because you cannot claim a medical insurance deduction against self-employment income when you have a loss, and you can only claim the deduction to the extent that you have a profit. So, for example, if your health insurance premiums cost you $10,000 for the year, but your profit was only $5,000, you could claim an adjustment to income for $5,000, and then the remaining $5,000 could go on Schedule A. But you couldn't claim 5 as an adjustment and then 10 on the Schedule A, clearly. The limit on the deduction for long-term care premiums. I'm finding that these are increasingly popular and that I have more and more clients who are paying for long-term care insurance premiums. They tend to be the most popular with my single clients or my married clients who are entering, their late 40s into their early 50s, and they don't have kids. Those people who have kids, I think, are expecting to a certain case that their kids might be helping them out. But I do have people with kids and without kids who pay for the insurance. It's just been my casual observation that individuals who don't have children, particularly single individuals with no children, are the ones most likely to pay for these contracts. And the reason they pay for them is that your overall normal policy for health care does not cover long-term care. And long-term care is when you have basically an ailment that prevents you from taking care of yourself and you need to go into a nursing home and have that attendant care provided to you. Most health insurance doesn't provide that. And it's incredibly expensive. It can be anywhere from $20,000 to $40,000 a year to be in a nursing home. And most people, if they have any kind of life savings, it's eaten up pretty quick by those costs. And so to protect their savings, a lot of individuals these days are purchasing these long-term care contracts that will provide some amount of coverage to help pay for long-term care if and when they ever need it. Now, in order to qualify as a deductible form of health insurance coverage, the contract must be guaranteed renewable. It must not provide for cash surrender value or other money that can be paid, assigned, pledged, or borrowed. It must provide that refunds other than refunds on the death of the insured or complete surrender or cancellation of the contract and dividends under the contract must be used only to reduce future premiums or increase benefits, and generally not pay or reimburse expenses incurred for services or items that would be reimbursed under Medicare, except where Medicare is the secondary payer or the contract makes per diem or other periodic payments without regard to the expenses. If you have a qualifying long-term care premium contract, the amount you can deduct for the qualified long-term contract depends on the age, your age, at the end of 2012 for the person for whom those premiums are paid. And here is the chart. You can see if you start paying for your long-term care insurance premiums, then the most you can deduct in the year at age 40 or under is $350. And the amount goes up each year until you hit age 71. And if you're age 71, you can deduct up to $43.70 per year. I don't have a lot of clients affected by these limits, but I do know that my software, my tax software, when it comes to making medical expense entries on the Schedule A, provides a line, a specific line for entering the amount paid for long-term care insurance premiums. And on that line, it asks you to tell the system, the software, how old the person was for whom the premiums were paid, so that if the limit applies, it applies it. And therefore, if you are using software that does not provide that feature for you, then you're going to have to do the mental math and make sure that your client is not attempting or does not claim on Schedule A an amount that is larger than is allowed for their age. I don't see the limit coming in too often, frankly. These limits seem to be in line with what insurance costs. So if you have a client who is being affected by the limit, they must have a more expensive than usual policy. Could be regional, of course. I'm just seeing that here in Portland, Oregon. Meals and lodging. Can you deduct the cost of meals and lodging as a medical expense? Well, you may claim the cost of meals and lodging related to medical care in certain situations, and how much you can claim depends on where you stay. If the meals and lodging are paid for staying at a hospital, they are deductible so long as your main reason for being in the hospital is to receive medical care. But in certain situations, you can also claim meals and lodging when you are not at a hospital. You may deduct the cost of lodging while away from home even though you are not staying at a hospital or a similar institution, provided all of the following is true. The lodging is primarily for and essential to medical care. The medical care is provided by a doctor in a licensed hospital or in a medical care facility related to or the equivalent of a licensed hospital. The lodging is not lavish or extravagant. There is no significant element of personal pleasure, recreation, or vacation in the travel away from home, and the cost for the lodging cannot exceed, get this, $50 per person per night. Now, in all the years I've been in taxes, which is now 21, I don't think this limit has ever changed, which tells me it probably came into being sometime during the Reagan administration or possibly earlier, when perhaps back then $50 a night bought you something not too bad. I seem to recall that Motel 6 back in the mid-'80s was around $10 a night. So $50 could probably get you a pretty nice pad. But today when Motel 6 is running $50 or higher, it's hard to imagine lavish and extravagant ever being an issue. But we're still limited to this $50 per person per night. And you are not allowed to deduct the cost of meals when you are not at a hospital. Now, there is an exception here for a nursing home or home for the aged. Expenses are allowable for you, your spouse, and your dependents, including the cost of meals and lodging, provided you are there for medical or nursing care reasons. Transportation as a medical expense. You can claim a deduction for transportation costs associated with a medical need. Allowable transportation expenses can include bus, taxi, train, airfare, or ambulance. Also, transportation expenses of a parent who needs to accompany a child who needs medical care. Transportation expenses of a nurse or another person who must accompany a person to provide medical treatment when that person is unable to do so alone. And transportation expenses to visit a mentally ill dependent if those visits are prescribed as a part of the patient's treatment. So for example, let's just suppose we have a child in a hospital. They're in there for a long term. They've got a form of cancer. And so they're in the hospital and they're getting treatment regularly. The parents are driving back and forth to the hospital every day. Obviously, it's to the benefit of the child and to be seeing their parent as often as possible and getting that emotional reinforcement from it. And so the IRS says that that would be a valid and deductible expense. Transportation expenses that are not allowed. Commute to and from work is never allowable, and transportation for non-medical reasons. For example, you travel to Hawaii for medical treatment available to you in your hometown. Car expenses. You can claim a standard rate of 23 cents per mile driven or the cost of gas and oil, but no allowance is allowed for depreciation or maintenance. And on to this disabled dependent care expense. You may be able to claim certain disabled dependent care expenses as a medical deduction or as a dependent care credit. Either is allowable, but remember you cannot double deduct by claiming both a deduction and a credit for the same expense. You can claim the deduction or the credit for a particular expense, but not both. Now clearly there's a limit on how much credit you can claim. It's a maximum of $3,000 of expense that could ever qualify you for a credit on a particular individual. And it's likely the case that if you have dependent care expenses related for a medical need, that they could far exceed that. So you could take $3,000 out of medical as a deduction and use it for credit, and then use the remaining or balance of the medical expenses as a medical deduction. Depending on your adjusted gross income and other factors, that could be beneficial. Capital expenses. You can deduct amounts you pay for special equipment installed in a home for home improvements. So when we're getting into capital expenses, the IRS is referring to a capitalized improvement. When you purchase a house, you've purchased a capital asset, and when you make improvements to that house, those are capital improvements. And so when the IRS talks about a capital expense, they're talking about an investment in something that has value over the long run. It's not a supply that gets used up. It lasts for more than a day or more than a year, and as such is considered to be investment into a capital asset. And the IRS says certain amounts that you pay for capital assets are deductible. You can deduct amounts you pay for special equipment installed in the home or for improvements if the main purpose is medical care for you, your spouse, or dependent as follows. If the cost of a permanent improvement increases the value of property, you may deduct the cost of that expense that exceeds the increase in the value of the property. If the value of your property is not increased by the improvement, the entire cost is included as a medical expense. Examples of the types of improvements that do not normally increase the value of property include constructing entrance ramps for your home, widening doorways or entrances or exits to your home, widening or otherwise modifying hallways and interior doorways, installing railings, support bars, or modifications in bathrooms, lowering or modifying kitchen cabinets and equipment, moving or modifying electrical outlets and fixtures, installing porch lifts and other forms of lifts. However, the IRS does say elevators generally do add to the value of the house. If you put a particular lift to get someone in the front door, they have to go up 3 steps to get in the front door. That kind of a lift would not add to the value of the house. If inside the house you have a staircase and you put a lift that carries them from the main floor up a chair that goes up the side of the staircase, that would not add to the value of the house. But if you actually installed an elevator, IRS says that does typically add to the value of the home. Also, items that don't typically add to the value of the home include modifying fire alarms, smoke detectors and other warning systems, modifying stairways, adding handrails or grab bars anywhere, whether or not they are in bathrooms, modifying hardware on doors, modifying areas in front of entrances and exit doorways, or grading the ground to provide access to the residence. Note that additional capital costs paid for personal motives such as architectural or aesthetic reasons are not medical expenses. Now, most of the things that we just listed there, not only don't they raise the value of your property in the IRS's eyes, I would think in many cases they probably devalue the property in the eyes of a potential buyer. If you're a healthy, active individual and you come across a house for sale and that house has a wheelchair ramp running back and forth through the front yard to get to the front door, that might be a negative for you, and therefore could even, you could say, lower the value of the property until it's torn out. And so those are the things that the IRS looks at. Is there an overall increase in value of the property because of that improvement to the property? And they have a worksheet here that you can use, and they essentially say enter the amount that you paid for the home improvement. Then enter the value of your home immediately before you made that improvement. Then enter the value of your home immediately after the improvement and do the subtraction. And if you ultimately have a difference there, then that difference is not deductible to you. Operation and upkeep. You can deduct costs paid for the upkeep of property that accommodates a medical need, even if the cost of the property is not deductible because it improved the value of your home. And this is an example that comes from IRS Publication 502 on medical expenses. You install an elevator in your home because you are unable to climb stairs. The cost of installing the elevator is $8,000, but the value of your home also increases by $8,000, so you were not able to deduct the cost of the elevator. However, the cost of electricity to operate the elevator and any cost to maintain it are a medical expense, as long as the main reason for the elevator exists as a medical reason. Impairment-related work expenses. If you are a person with disabilities, you can take a business deduction for expenses that are necessary for you to be able to work. If you take a business deduction for these impairment-related expenses, they are not subject to the 7.5% limit that applies to medical expenses. You have a disability if you have a physical or mental disability, for example, blindness or deafness, that functionally limits your being employed, or a physical or mental impairment, for example, a sight or hearing impairment, that substantially limits one or more of your major life activities, such as performing manual tasks, walking, speaking, breathing, learning, or working. Impairment-related expenses defined. Impairment-related expenses are those ordinary and necessary business expenses that are necessary for you to do your work satisfactorily. They are for goods or services not required or used other than incidentally in your personal activities, and they are not specifically covered under other income tax laws. If you have an impairment-related work expense, you report the expense on Form 2106, and then you carry it over on Schedule A, but you don't deduct it on the medical line. You deduct it way down at the bottom under other expenses not subject to the 2% limit if you are an employee. If you're self-employed and you incur work-related expenses, you enter those on Schedule C, CEZ, E, or F that is used to report your business income and expenses. And again, for that person who is an employee and incurs those work-related expenses, you complete the 2106. You enter the expense on line 28, which is where you enter expenses not subject to the 2% limit, and you do not enter the expense as a medical expense. You enter the amount that is unrelated to your impairment on Schedule A on the usual medical line, or on line 21 if it is another work-related type expense that is not impairment-related. And here is an example that the IRS provides in its publication on an acceptable description of an impairment-related expense. You are blind, and you must use a reader to do your work. You use the reader both during your regular working hours at your place of work and outside of your regular working hours away from your place of work. The reader's services are only for your work, so you can deduct your expenses for the reader as a business expense, and that would not be subject to the 2% limit or the 7.5% limit. You'd figure the expense on 2106 and then enter it on line 28 of the Schedule A. So I've just summarized some of the main types of expenses that people can claim. But this is a list of expenses, and each of these items that you see here usually has a paragraphical description accompanying it. And I have not copied the paragraphical description out of Publication 502, just mainly the item itself. And if you want to know more about the particular item, you go to Publication 502 and read more about it. But we'll go through the list just so that you kind of in your memory cells have all of these things registered there in case they ever come up in a conversation with a client and you're scratching your head. You'll have some, hopefully, memory retention of what we'll cover today. Firstly, you are allowed to deduct alcohol addiction treatment, including Alcoholics Anonymous meeting attendance. You can claim the cost of an ambulance, your annual physical examination, artificial limbs, artificial teeth, and autoet, which is one of those electric wheelchairs, bandages, birth control pills, a body scan, Braille books and magazines, costs exceeding the price of a regular book. So a Braille book is more than a regular book of the same edition. To the extent that the Braille book is more, you can deduct that. Breast pumps and supplies, breast reconstruction surgery, car, including medical improvements and medical use operating costs, chiropractor. And again, chiropractor is a good example of one where clients frequently feel that a chiropractor would not qualify, but it does. Christian Science practitioner, conferences, medical. The cost of meals and lodging while attending the conference is not deductible as a medical expense, but the cost of the conference is. And not that long ago, I actually had a client who had a rare disease, and he was wanting to know whether the cost of attending a conference was deductible. It was in Seattle, we're in Portland. And the answer is, well, the cost of traveling to Seattle and staying in Seattle for that conference, no, but the actual admission fee to get into the conference, yes. Contact lenses are allowed as a medical expense, as are crutches, dental treatment, diagnostic devices such as blood sugar test kit, disabled dependent care expenses, drug addiction treatment. Drugs, legal drugs, of course, eye exam, eyeglasses, eye surgery, fertility enhancements, surgery, founder's fee, guide dog or other service animal, the cost of purchase and care of the animal is allowed. Health institute, prescribed by a physician for necessary treatments. Health maintenance organization or HMO, hearing aids, home care, home improvements. Hospital services, insurance premiums, hospitalization, surgical services, x-rays, prescription drugs and insulin, dental care, replacement of lost or damaged contact lenses, and long-term care subject to additional limitations, Medicare B, Medicare D, prepaid insurance premiums, but restrictions do apply, intellectually and developmentally disabled, special home care, laboratory fees, lactation expenses, lead-based paint removal, legal fees paid to authorize treatment for mental illness, lifetime care. Lifetime care, advanced payments eligible to medical care. What this is referring to is you are looking, say, we had a good example of this in my office this year. We have a man who his mother's got Alzheimer's. He's applied to a higher-end medical nursing home facility here in Portland. And the admission fee just to get his mother in the door was something like $90,000. He had to cash out most of her IRAs in order to pay this admission fee. And most of the admission fee, though not all of it, was deductible as a medical expense. And what the lifetime care or founder's fee that was charged, how did we arrive at that number? It was actually the medical nursing home itself that in the letter of admission stated how much of the admission fee was for medical and how much was going to be held out for future years and could possibly be refunded. And so based on what that institution said was deductible, that is the amount we put on the return. And according to IRS, that is acceptable, that whatever the institution tells you is the amount that should be medical, that's the amount that you can claim as medical. For dependents with disabilities, you can include in medical expenses advanced payments to a private institution for lifetime care treatment and training of your physically or mentally impaired child upon your death or when you become unable to provide that care. The payments must be a condition for the institution's future acceptance of your child and must not be refundable. Lodging is deductible, as I already described. Long-term care services and insurance premiums. Meals, but again referring to the rules I stated earlier, which are basically meals at the hospital or at a nursing home. Medical information plan. Medicines, but only if they are by prescription, with the exception of insulin. You can purchase insulin and claim a medical deduction for that even if you do not have a prescription. Nursing home, including meals if the reason is medical care. Nursing services or similar services. Operations except for cosmetic. Optometrist, organ donors, osteopath, oxygen, physical examination by a physician. Prescription drug purchased and consumed in another country if the drug is legal both in the other country and in the United States. Pregnancy test kit, prosthesis, psychiatric care, psychoanalysis, psychologist, special education. You can include in medical expenses fees you pay on a doctor's recommendation for a child's tutoring by a teacher who is specially trained and qualified to work with children who have learning disabilities caused by mental or physical impairments, including nervous system disorders. So something that comes to mind under that would be perhaps you have an autistic child, and that autistic child is unable to adequately learn in a normal classroom. They're attending a regular classroom. They're getting some special assistance or intervention in that regular classroom, but it's not nearly enough. And so you bring in a specialized tutor equipped to deal with autistic children to tutor your child at home and give them some basic skills necessary for life function and learning in school. That, in that kind of situation, could also be deductible. Teaching Braille to a visually impaired person. Teaching lip reading to a hearing impaired person. Giving remedial language training to correct a condition caused by a birth defect. Sterilization, stop smoking programs, surgery. Telephone devices for hearing impaired, and television devices for hearing impaired. Therapy, transplants costs including the payment to the donor. Transportation, trips when necessary for medical treatment. Tuition, if special education required to address medical condition. And vasectomy, vision correction program, and a weight loss program. And we touched on weight loss earlier, but I'm bringing it up again here. You can include medical expense amounts that you pay to lose weight if it is a treatment for a specific disease diagnosed by a physician, such as obesity, hypertension, or heart disease, as follows. You can claim the cost of fees you pay for membership in a weight reduction group, as well as fees for attendance at periodic meetings. Memberships in a gym, health club, or spa are not allowable as medical expenses. However, you can include separate fees charged by a gym or health club for weight loss activities. You cannot include the cost of diet food or beverages in medical expenses because the diet food and beverages substitute for what is normally consumed to satisfy nutritional needs. But you can include the cost of special foods in medical expenses only if the food does not satisfy normal nutritional needs, the food alleviates or treats an illness, and the need for the food is substantiated by a physician. The amount you can include in medical expenses is limited to the amount by which the cost of the special food exceeds the cost of normal food. Wheelchair is allowed, a wig is allowed, on a physician's advice for a patient who has lost hair from a disease, for example, cancer, and x-ray. So what's not allowed? Because that was such a long list of what you could claim, let's look at a few things that are not allowed. Following is a list of some of the things you are not allowed to claim. Babysitting, childcare, and nursing services for a normal, healthy baby. Controlled substances. Cosmetic surgery. Generally, you cannot include in medical expenses the amount that you pay for unnecessary cosmetic and surgery, and this includes a procedure that is directed at improving the patient's appearance and does not meaningfully promote the proper function of the body or prevent or treat illness or disease. You generally cannot include in medical expenses the amount you pay for procedures such as facelifts, hair transplants, hair removal, electrolysis, and liposuction. You can include in medical expenses the amount that you pay for cosmetic surgery if it is necessary to improve a deformity arising from or directly related to a congenital abnormality, a personal injury resulting from an accident or trauma, or a disfiguring disease. And then they give an example here. An individual undergoes surgery that removes a breast as part of treatment for cancer. She pays a surgeon to reconstruct the breast. The surgery to reconstruct the breast corrects a deformity directly related to the disease. Therefore, the cost of the surgery is includable. Diaper services, except where the diapers are required due to the effects of disease. So if you pay for diaper service, that's not normally allowed, obviously, if you have a baby. But if you have an elderly person who is unable to control themselves anymore, so you employ a diaper service for that, that would be allowed. Electrolysis or hair removal. Funeral expenses, future medical care, hair transplant, health club dues, household help, illegal operations and treatments, maternity clothes, medicines and drugs from other countries. And this is a key one. If we look here at the very next one, it says prescription drug brought into or ordered from another country. Now, of course, in the United States, prescriptions are very, very expensive. If your health insurance doesn't cover it and you go to purchase a particular prescription item, you may find very easily that that same exact drug is available in Canada for anywhere from a third to a tenth the cost. So it could make sense to you to order those prescriptions in from Canada, and it's really quite easy to do that. You just order them online and they get shipped in and they arrive in your mailbox and you can use them, and you've just saved yourself a boatload of money. But the IRS says that that is not an approved drug in the United States if you purchased it in a foreign country and brought it into the United States. And they say if it was approved for that, then you can claim it. But when I did research on this about a year ago, I was able to determine that there has never been an approval by the FDA for import of any drug from another country. That has never happened. So essentially, it's a method of forcing you to pay more for drugs here in the United States. But if you choose to not pay the higher price here, which is deductible, and instead choose to pay for the drug in another country where the import is not deductible, you may still be ahead. Finally, non-prescription drugs and medicines, except for insulin, are not deductible, and nutritional supplements such as vitamins. You cannot include in medical expenses the cost of nutritional supplements, vitamins, herbal supplements, natural medicines, etc., unless they are recommended by a medical practitioner to treat a specific medical condition. How do you go about claiming your medical deduction? Well, you claim your medical deduction by adding up all of the amounts that are legally deductible and entering those on line 1 of Schedule A. Then you go over to line 2 and you enter your adjusted gross income, and then you multiply that amount by 7.5%. You subtract 7.5% from the amount of medical that you have, and you enter that difference on line 4, and that is your allowed deduction for medical.
Disney, D-I-S-N-E-Y. Disney.
With that, we're on to the next topic of the day, which is deductible taxes. And taxes are reported on Schedule A. There's about 4 different lines that you can be entering taxes on, and we're going to take each of those lines in turn today. The lines on which you claim deductions are 5, 6, 7, and 8, and then you total up your taxes that are deductible and enter the total on line 9. There are rules that you have to adhere to. For a tax to be deductible, it must meet 2 tests. Firstly, the tax has to be imposed upon you, and secondly, the tax must be paid by you during the year. So what does it mean to be imposed upon you? The tax must be imposed on your property or on your income. Taxes you pay on property that you do not own generally are not deductible. So for example, you've got a sister who owes some back taxes on her house, and you're nice enough to come along and pay those for her to get her out of arrearages. Is that deductible to you? Well, the answer is it was paid by you, but it wasn't assessed against you. It wasn't incurred against you. It wasn't on property that you own. And so the answer is no, it's not deductible. And your sister wouldn't be allowed to deduct it either because she didn't pay it. So in that situation, no one would get to deduct it. It would make far more sense to allow your sister to pay it herself by perhaps giving her a gift of money and then allowing her to turn around and pay those back taxes with it. So what does it mean paid by you? Assuming you are a cash basis taxpayer, and nearly everyone is, you must pay the tax during the year for which you are filing. So here's an example. The tax is imposed but not paid. If the tax is imposed on you in 2012 but you don't pay it until January 2013, you cannot claim a deduction for it on your 2012 return. You will, however, be able to claim a deduction for it in 2013. And this actually comes up quite a bit. Most states, I believe, pay property taxes on homes based on the calendar year. I know Washington State to the north of us and Oregon does it that way. There's 2 tax payments made each year, typically one at the beginning of the year, one halfway through the year. Oregon's a little bit different and somewhat confusing in that the assessment period in our state is fiscal. It starts July 1st and ends June 30th of the following year, and the bill for the year comes in November. So when you get a bill in November, that bill is for the 5 months that preceded it from July through November, and for the 7 months that follow it, November through June 30th of the next year. And most Oregonians pay that property tax bill when it arrives in November because they're given a discount as an incentive. If you pay the tax early, you're going to get 2% off. And so most do that. But there's plenty who don't. There's plenty who get that bill in November and pay 1/3 in November. And then another third is due in February, and a final third is due in May. And so when my client brings me a property tax bill, I don't assume that they paid it. And you shouldn't either, even if your state's much easier to understand than Oregon. If you've got a bill that comes sometime in January and it's due by February, and then there's another bill that comes in July and you pay it in July, that's pretty straightforward. You've got the bill and you paid the bill. But you can't assume that your client paid the bill just because they got it. And the IRS won't just accept an assessment notice from the county as proof that a bill was actually paid. And neither should you as a tax professional. So when I have a client come to me and they deliver me the notice showing that they were assessed the tax, the first question I ask is, okay, the assessment notice is for $3,500. Did you pay that all in November? Or did you pay it in thirds? Or perhaps did you not pay it at all? And most of the time it's coming out of the escrow account they have with the mortgage company. The mortgage company is paying it, and it was paid in November. But believe it or not, one year I actually had a client who the mortgage company had been taking money and putting it into escrow all year long, and then when November came, they didn't pay the bill. And so the tax had been taken from the client in the forms of the escrow, but the tax had never been paid. The client wasn't allowed the deduction because escrow hadn't sent it where it was supposed to. So again, another system I have is to actually call the county and ask the county what dates and amounts that a bill was paid. Now, some states have wonderful online systems where you can actually log in, type in a property address. Washington State is an example of this. If I have a client from Washington and we're trying to figure out how much property tax they paid because they don't remember the date or the amount, we can actually log on to a site with Washington and type in their address and look up how much tax they paid. The system will actually say the amount paid and the date it was received by the state. Oregon, not so simple. Oregon has a system, but it really just shows that the tax was paid. It doesn't show that the date that it was paid. So if my client receives an assessment in November of 2012, but doesn't pay it until February of 2013, and I'm logging on in March of 2013, I'll be able to see that the bill was paid, but not the date that it was paid on. And so essentially that's no good for me. So ultimately I have to call people at Multnomah County where I live, or Washington County, whichever county my client is from, and find out what date the county actually received the money. And I'll get answers like, well, we got a payment for $500 in February of 2012. We got another payment for $1,300 in July of 2012. Then we got a payment for $50. Then we got a payment for blank dollars. And I have to add all of those up. Whatever I get is the deduction that my client gets. And obviously it isn't approximating even remotely the amount that's on the notice that they presented to me. So let's look at the types of taxes that are deductible, starting with income tax, because we're going to take the Schedule A in order, and the very first line on which you enter a tax deduction for taxes is Schedule A line 5A. And on line 5A, you enter deductions for income taxes. You may deduct the following kinds of income taxes that you paid during the year: state and local income taxes that were withheld from your wages. State and local estimated taxes that you paid during the year can be deducted if you reasonably expected that you needed to actually make the payment. So in other words, if you thought that you wouldn't need to make the payment but you did it anyway, the IRS says you can't deduct that. A refund of state taxes that you choose to have credited to your next year's estimated taxes is deductible, but it's deductible in the year you make that credit forward. State or local government balance due income tax payments that you paid during the year are also deductible. So in 2011, you have a tax return that is filed in 2012. And in 2012, you pay your balance due to the state. Because that payment is in 2012, you get to deduct it on your 2012 return. You wouldn't deduct it on 2011, even though the payment is for 11, because you didn't make the payment till 12. Mandatory contributions to state benefit funds withheld from your wages that provide protection against the loss of wages are also deductible, but only for those states that actually participate in the right kind of program. Certain states require employees to make contributions to state funds providing disability or unemployment insurance benefits, and those states are listed here. They come out of Pub 17. If you don't see your state listed in Pub 17, then even if you have a similar kind of tax, it would not be deductible. So payments for the following state funds qualify, including the Alaska Unemployment Compensation Fund, the California Non-Occupational Disability Benefit Fund, New Jersey Non-Occupational Disability, New Jersey Unemployment Compensation, New York Non-Occupational Disability Benefit Fund, the Pennsylvania Unemployment Compensation Fund, the Rhode Island Temporary Disability Benefit Fund, and the Washington State Supplemental Workers' Compensation Fund. Note that employee contributions to private or voluntary disability plans are not deductible. California has the California State Disability Fund. It's called California SDI. And if you see a California W-2 with SDI on it, the amount of SDI is deductible. But California also allows certain employers to opt out of SDI and instead go into voluntary disability fund. And if you have an employer who did that, then the amounts into that voluntary fund are not deductible. So here are some examples of taxes that are or are not deductible. Estimated tax payment is not deductible. You made a $3,000 estimated payment to your state in January of 2013 for your 2012 state tax return, even though you knew this would result in an overpayment of tax to your state. When you file your state return in April 2013, you receive a refund of $4,000. You may not claim a deduction for that estimated tax payment of $3,000 on your federal 2002 return. Well, there's two reasons. One is you didn't expect to owe the payment. You paid it in January, and it wouldn't be deductible until the next year anyway. So if you're going to make an estimated tax payment in January of 2013 to pay the final quarter of 2012 on your state return, that 2012 payment was made in 2013, so you wouldn't be able to deduct it until the next year when you file the 2013 return. If you have a 2012 estimated tax due on January 15, 2013, and you choose to make that in December instead, because the payment went out in December, it would then be deductible on the 2012 return, but only if you reasonably expected to owe the tax. And if, in fact, that tax is refunded to you because you knew you didn't have to pay it, and in fact you didn't have to owe it, then it's not deductible. Here is another example. An overpayment amount is applied to estimated tax payments. You elected to apply $500 of refund from your 2012 state return towards 2013 estimated taxes. You include this $500 payment as an itemized deduction on Schedule A when you file the 2013 tax return a year later. Example number 3, you file your 2011 state return on April of 2012. You had a balance due of $500 and you paid that balance due before the end of 2012. You can claim a Schedule A deduction of $500 for the year that tax was paid when you file your 2012 return. Refund of income taxes. Do not reduce the amount of your income tax deduction by refunds you received during the year. If you receive a refund of taxes paid for an earlier year and you previously received a tax benefit from deducting the tax for the earlier year, you must include the refund in your income to the extent that you received a tax benefit. And here is an example. The state refund is not taxable. Now, most of the time, but you can't rely on this rule, but most of the time when a 1099-G is issued by a state, that state is informing you that a refund was issued, and this 1099-G typically is not issued unless the person itemized their deductions the year before. So if a person didn't itemize in the year before, even if they got a refund from the state, typically the state will not issue a 1099-G. But I have seen situations where 1099-G is issued even though a state refund is not taxable. So just because there is a 1099-G doesn't mean you should assume that it is taxable, but it means you should assume that it might be taxable, and you need to do the research to determine if it is. Here we have an example where the state refund is not taxable. You did not itemize your deductions in 2012, and you received a state income tax refund of $400 on your 2011 state tax return during 2012. Because you did not receive a tax benefit from deducting the taxes from your federal income, you do not need to report that 2011 state refund as income on your 2012 return. Example number 2, the state refund is fully taxable. You did itemize in 2011 and you received a full benefit from claiming your 2011 state income taxes as an itemized deduction on your federal return. You must include the $400 state tax refund that you received in 2012 as income on Form 1040, line 10 for 2012. In our third example, we have a refund that is partially taxable. In this illustration, you also itemized in 2011, but you received only a partial benefit from claiming your state income taxes as an itemized deduction. You must determine what portion of state income taxes paid actually benefited you when you claimed them as a deduction on your 2011 Schedule A. Include as income only the amount of taxes deducted that actually benefited you. And here is an illustration of figuring the taxable part of a refund. This is a really generic example, kind of pulling from the instructions that the IRS gives you on how to determine the amount of tax benefit you received based on the difference between your standard deduction and your itemized deductions. But there are other factors that come into play that worksheet does not account for, so I don't always completely rely on this worksheet and say, oh, the worksheet produced a taxable amount, therefore it is, because sometimes there was no tax benefit even though the tax worksheet shows it might have been taxable. And I'll get into that a little bit more in a second. So in our illustration, in April of 2012, you filed your married filing joint 2011 tax return. Your itemized deductions that were claimed on Schedule A added up as follows. Charity was $1,000, state income tax was $2,000, mortgage interest was $7,500, and property taxes were $1,100. In May 2012, you received a state refund of $1,000. You calculate the taxable portion of your refund as follows. Firstly, you'd look at the total of all of your itemized deductions, and if you add up the itemized deductions, you get $11,800. The standard deduction for 2011 is only $11,600, and the difference is $200. Therefore, the total refund received is $1,000, but only $200 of it is taxable. Your taxable refund is the lesser of $200, or the refund you received. And in this example, the lesser amount is $200. You should report $200 as income on line 10 of your 2012 1040. The calculation is shown on the following worksheet. So the IRS provides a worksheet, which is shown next, and we basically take the numbers from the situation. We say, what was the itemized deductions claimed on the Schedule A? The Schedule A itemized deductions add up to $11,800, and then we subtract out what would have been the standard deduction for 2011. And the difference between those, that $200, is the amount that's taxable. Well, one of the things I get into with this worksheet is that it doesn't factor for certain other things. It could be, for example, that your itemized deductions were so much more than your income that if you hadn't itemized or claimed all of your itemized deductions, there still would have been no difference in your net tax. So let's just suppose your itemized deductions are $25,000, your income is $35,000, and you claim 3 dependents. Odds are that you could have had much smaller itemized deductions and still come up with the same net tax. And therefore, the fact that you claimed a full deduction for state income tax and then received a refund from the state doesn't always, to me, equate that you're going to have a fully taxable refund. So I like to look at what last year would have been if I didn't claim state taxes as a deduction. And if I had left state taxes off as a deduction, would their refund have changed? Because if it wouldn't have changed, then they didn't receive a tax benefit from deducting them. But the worksheet itself doesn't really accommodate for that. You just need to understand the concept well enough to go and figure it manually. And if not, you can rely on the worksheet.
Theoden, T-H-E-O-D-E-N. Theoden.
Deduction for the sales tax paid. This is the next line on 1040, and it is line 5B. The deduction for state and local income taxes is a temporary deduction that was brought into law during the Bush administration. It was set to expire for years after 2009. However, extensions were made under the Reed-McConnell Tax Relief Act and the Unemployment Reauthorization and Job Creation Act and the Taxpayer Relief Act of 2012. So they keep extending it. Right now, it remains available all the way through 2013. The deduction is offered in place of the deduction for state and local income taxes, which means you can claim one or the other, but not both. If you elect to deduct income taxes on your Schedule A, you would check box A on line 5. And if you elect to deduct sales tax, you check box B. Whichever box you check, you then carry the total over to line 5. If you choose to claim the sales tax deduction and you check box B, you can claim a deduction for sales tax paid using one of the following 2 methods. Under method number 1, you use the actual amount of state and local sales taxes that you paid. To calculate the actual sales tax paid for the year, you need to save all of the receipts showing all of the sales tax you paid for the year, and then you would need to add up all those receipts. And that's allowed. Method number 2 is meant to relieve you of the responsibility of saving all those receipts and adding them up. For method number 2, you would instead complete the state and general sales tax deduction worksheet, which is shown next, using the optional state sales tax tables. The worksheet is shown here, and it basically takes you step by step through figuring the amount of income that you have, figuring the percentage tax rate your state assesses. It then looks at an additional local rate that your state might have for the locality that you live in, and then you do some multiplications. Down on line 7, it asks you to enter additional sales tax amounts that you paid on large ticket items like boats and airplanes and cars. And if you made any large ticket purchases during the year, you can make a straight entry on line 7 for the sales tax paid on those items, and then you add it all up on line 8 and you have your deduction. But to show you how the worksheet works, I've provided a couple of illustrations. The state and local income tax sales deduction worksheet. So for line 1 on that worksheet, you find the state where you lived in 2012 and the optional state and certain local sales tax tables. And I do have those in the manual a couple pages later. The tables ask you to select the correct dollar amount using the following 2 pieces of information: the number of exemptions that you are showing on your tax return for 2012 and the number that is shown on line 38 of your 1040 plus any non-taxable income. Line 38 is, of course, your adjusted gross income, but the IRS understands, or government understands, that you could use tax-free income and use that tax-free income to pay sales tax. So they don't want you to work just off your adjusted gross income. They want you to add in any other forms of income that you had that were non-taxable, because you would have paid sales tax using those non-taxable forms of income, and you can add that into the equation. So examples of non-taxable income that you add into your income for purposes of using the table include tax-exempt interest, VA benefits, non-taxable combat pay, workers' compensation, non-taxable Social Security and railroad retirement benefits, non-taxable withdrawals from pensions, IRAs, or annuities, and public assistance programs. If you are a part-year resident of your state, figure the amount to enter on line 1 by multiplying the amount from the tables by your percentage residency as follows. State A. So yeah, if you're a resident of more than one state, you're going to have to essentially do the table twice. For state A, you would take the amount from the table and you would multiply that by the number of days in the state and then divide that by 366 to get your decimal ratio. And for state B, you would do the same thing. You'd take the amount from the table, you would multiply that by the number of days you lived in the state, and then divide that by the decimal ratio. I see a question coming in from Harvey Pascal. Is there now in 2013 a sales tax on the sale of your residence? Well, that would be a state-specific thing, Harvey. If your state has a sales tax that's paid on the sale of your house, then you would have a sales tax. And actually, sales tax that's deductible is typically sales tax that's paid by the buyer. So if you're buying a house and you paid sales tax on it, that would be something in your state. You happen to be talking to a person who lives in one of the only states in America that doesn't have a sales tax. Oregon does not have one. We're a boon for people who love to come here and shop. They hit our outlets and shop their little hearts out because we don't have a sales tax. So I'm not really an expert on sales tax per se. But what I can tell you is that sales tax is something that's paid at the time you purchase an item to the state. If you're the seller of a home, you wouldn't be paying sales tax because you sold your home. You might be paying a form of a transfer tax, and that transfer tax could even be a percentage of the value of the house. But the IRS specifically says that a transfer tax is not a sales tax and is not deductible. It would be an expensive sale. It would reduce your profit from the sale, but it's not a sales tax. So here's an illustration we have of how to fill out the worksheet where you calculate the amount of your sales tax deduction. But we've made it a fairly complex one because we've given you a person who is a resident of 2 states. And here we have Mike, who is a single filer with income totaling $40,000. And during the year, he resided in the following states. He was a resident of Orange County, California, and he was in California from January 1, 2012 through April 30, 2012. He was then a resident of Clark County, Washington from May 1st, 2012 through December 31, 2012. We've got it narrowed down to the county because there is a county tax that is deductible as well, and you can only figure that county rate by knowing what county the filer lived in. So we've actually gone out of our way to tell you the counties that he lived in. In March, Mike bought a new boat. He paid $2,720 of sales tax on the boat at the time of the purchase. You calculate Mike's sales tax deduction for 2012 as follows. Based on Mike's income, the amount for a single exemption on each state is as follows. For California, it's $669, and for Washington, it's $659, and I'm telling you to look at pages 30 and 31 of your manual, so let's go do that. Here's page 30, and I've gone here ahead and put a red box around Mike's income. His income is at least $40,000, but less than $50,000. In fact, his income is exactly $40,000, so we've circled that. We then go over to California, and he hasn't got any dependents. He's a single fellow. So we just follow column 1 down, and we come to the line for him. California state sales tax amount that was paid for Mike, a single filer, is $669, and this is the state of California. We go down one more page, and we've got the state sales tax tables for other states. And if you look in here, I mentioned Oregon, Ohio, Oklahoma, there is no Oregon. That's why, no sales tax here. We then move down to the income for Mike again, $40,000, and this time we're looking at Washington State, and we can see that the amount of tax he's paid to Washington State is $659. You'll also notice the rate of tax is 6.5%, and the IRS on the sales tax worksheet asks for that rate of tax. California is 7.25%, and Washington was 6.5%. So we go back up to our problem for Mike, and we enter $669 for California and $659 for Washington. We then need to figure out how many days he resided in each state. And I'm a bit of a finger counter, so I say, well, there's January, there's 31 days. 2012 was a leap year, so February had 29 days. We had March at 31 and April at 30. So I add that up and I get 121 days. And because it was a leap year, we had 366 days in 2012. And that means 0.3306 of the year was spent in California, and that means of the $669, he's going to be allowed 33.6%, or $221. For Washington, that same formula gives us 245 days. 245 out of 366 is 66.94%. You multiply that by the amount we got from the table, $659, and we end up with $441.13 for California, and that gives us a total of $662.30. And we're going to have to do two separate sales tax worksheets, one for California, one for Washington. And we've done all of this effort just to figure out what to put on line 1 of each. Once we've done that, we move on to line 2. And line 2 of the worksheet is asking, did you live in any of the counties listed? And the answer is no, Mike did not live in any of the counties listed. So then we move on to line 3, and it says, did you pay sales tax at the local level? And the answer is yes. So then what was the sales tax at that local county level? And if you look up the sales tax rate for Orange County, and how do I figure this out? I go online and look it up. And then ask what was the sales tax rate for Clark County, same thing, how do I figure that out? I go look it up. Well, for Orange County, the local rate, the locality rate for Orange County is 0.5%. And for Washington State, it's 1.85% in Clark County. So we're asked to look those amounts up, and then we're asked to return to the regular tables and look up the sales tax rate for California. It's 7.25%. For Washington, it's 6.5%. The next step is a rather odd one, I think. It's asking you to take the local rate for the state and divide that by the state rate. So it's 0.5% for Orange County. You're going to divide that by 7.25% for the state as a whole. And when you do that, you get this number, 0.0690. And you do that same calculation for Washington with Clark County. And the Clark County rate of 1.85 is divided by the 6.5 for the state as a whole, and you get 0.2846. Once we've done that, we're now going to return to those first computations that we did for line 1, and we're going to take those totals, $221 for California, and multiply that by 0.690, and when we do that, we get $15. We do the same factoring for Washington, multiply 441 by 28.46, and when we do that, we get $125.55. Now, in the wording of the problem up here, I also tell you that he paid a flat dollar amount to buy a new boat. He paid $2,720 of sales tax when he bought that boat, and that amount that he paid for that boat is going to be added in to the worksheet on line 7. And once you're finished with all of that, you add up the amounts of tax that you calculated. We have $221.17 for the state of California as a whole. We have another $15.26 for Orange County. We have $2,720 paid on the purchase of the boat. And we add up all of those amounts. We have $2,956.43. We then go over and add in the Washington amounts, $441.13 to Washington, plus another $125.55 to Clark County, and we get $566.68. And the final step is, of course, to add the $2,956 to the $566, and when we do that, we get $3,523. We now have a number to enter on Schedule A. We're going to check line 5B and then enter the total of $3,523 on line 5. Quite a bit of work when you're dealing with two states. The IRS does have a worksheet on their website where you can go and type in these amounts. And you can click on this link that we have in the manual. It will take you to that calculator. We've done that for you already and inserted the results in the manual. If you go into the calculator, and it just walks you through step by step, and the calculator will say, what was your income range? Then it'll ask you for the number of exemptions. Then it will ask you the zip code that you lived in. And IRS is smart enough to know that if you type in a zip code, it'll know what the local tax rate is. So it will figure all of this for you. And ultimately, when we're finished using the IRS calculator, we get the exact same number that I just showed you by filling out the worksheet by hand. So obviously filling out the calculator could be simpler, but I like to show the worksheet so that you understand the calculations going into it. Now illustration number 2 is much easier than illustration number 1. In illustration number 2, we're dealing with a full-year resident who is a resident of a single state the entire year. It's a married couple, Sam and Jane, and they have 2 dependent children. These folks were residents of Clark County, Washington for the entire year. Their income from 1040, line 38, plus their non-taxable income not reported on 1040 was $80,000, and they paid $40,000 for a new SUV during the year. Let's go over and see what the tables show for them. So they're on page 31 because they're residents of Washington, and their household size is 4. So we're going to go down the column for 4, and we're also going to use the column for $80,000 of income. And when we do that, we get $1,066. And again, we have that 6.5% rate. So on their worksheet, again, we can go into the IRS website. And when we do that, we enter the state that they're a resident of, the income that they had, the number of exemptions that they claimed. It automatically tells us the state rate and the local rate. The percentage residency is 100%. The state amount is $1,066. We saw where that came on the table. It adds in $303 for the local rate and comes up with a total tax of $1,369. Normally, that would be the amount they get to enter on Schedule A. But they did purchase a big ticket item on which they paid another $3,340 of sales tax. So ultimately, that bumps their deduction up to $4,709. We're going to carry that to the Schedule A. We're going to put an X in box 5B, and on line 5, enter the number. And here is the worksheet all filled out for Sam and Jane. $1,066 is the rate or amount we pulled off the table. 1.85% is the Clark County rate. 6.5% is the Washington State rate. The division of that gives us 0.284615. We multiply that out, we get $303. We basically take $1,066, multiply it by the amount on line 5, and we get $303. We then add in the sales tax paid on the big ticket item, and then we have $4,709. So this is a particular worksheet that was generated by my tax software. Your software may generate the worksheet, or you may have to do it manually or by going to the IRS website. So I've now shown you all of the different methods for calculating it. Now on the worksheet, let me back up a bit here. Right here it says, did you live in Alaska, Arizona, Arkansas, Colorado, Georgia, Illinois, Louisiana, Missouri, New York, North Carolina, South Carolina, Tennessee, Utah, Virginia, or West Virginia? If you answered yes to any of that, then you would go and use the next table that we have in here, which is this one right here. Rather than looking up the local rate, you can actually use a rate based on the alphabetical listing here. So if you resided in Alaska, regardless of the locality, you wouldn't need to go look up a special rate for Alaska. Instead, you would look at C. It's telling you to use Table C, and then you would find your income. Let's say you're a single person with $50,000 of income living in Alaska, locality C. You would follow that over, and it would give you $136. And you would use that number instead of figuring it manually using the calculations that I showed you. So actual expenses versus the optional sales tax tables. You can choose to deduct the amount of sales tax you actually paid for the year, or you can choose the optional method of calculating sales tax. So what's the benefit of actual expenses? Well, it could be that you spend a lot more than the average person, and so the amount that the tables are showing is really not even close to what you actually spend in sales tax each year, even not accounting for big ticket purchases like motorhomes, airplanes, cars, and so forth. That you're just paying a lot more sales tax than the average person. Maybe you're out buying big screen TVs and home entertainment systems and fancy furniture, and just the tables aren't giving you a big enough number. So you find that it's beneficial to save all your receipts and total them up. And if you do that, you could get a higher number and claim that higher number as a deduction. But the optional sales tax tables do provide a good method of coming up with at least some kind of a deduction in a method that IRS will allow. if you are no good at saving receipts or just simply decided you can't be bothered. So again, just as a reminder or a summary of the rules, you can use the tables to figure out the sales tax deduction based on your income and household size and the state and the locality that you live in. In addition to the number that you figure on the table, you are also allowed to claim a deduction for sales tax you pay on the purchase of big ticket items, including a motor vehicle, but only up to the amount of tax paid at the general sales tax rate, as well as on aircraft, boat, or home, including a mobile or prefabricated home or home building materials, if the rate is the same as the general sales tax rate. So again, returning to the question that was posted in here earlier, Harvey asked, can you claim a deduction for sales tax paid on a residence? Well, if you're purchasing the residence and the state imposes a sales tax on that purchase that the buyer has to pay, then yes. But typically when you're the seller, you're paying a form of transfer tax, and the answer on that would be no. Now, the sales tax deduction will mainly benefit taxpayers that have a state or local sales tax but no income tax. So the state of Oregon is definitely not on that list, but there's a number of states that have a sales tax and no income tax. In other words, they're the opposite of Oregon. And those states include Alaska, Florida, Nevada, South Dakota, Texas, Washington, and Wyoming. And I think there's one or two other states that have income tax, but it's very minimal. And they might have a minimal income tax, but they have a very large sales tax. So it could be the case in some states that you're paying more sales tax than income tax. Taxpayers living in states with both income tax and sales tax are basically going to have to make a decision year to year. Am I better off claiming the income tax deduction, or am I better off claiming the sales tax deduction, because you're never allowed to do both. But if you're in a particular year where you purchased a really big ticket item and your sales tax was through the roof, you might find that you're better off with that than you are with the income tax deduction. The discussion of real estate taxes. And real estate taxes are deducted on Schedule A, line 6. You can claim a deduction for taxes imposed on real property you own, provided the taxes are assessed based on the value of your property. They are levied for public welfare. The tax is imposed upon property that you own, and it must have been paid by you. Taxes assessed to improve the value of your property are not deductible. An example of a non-deductible tax is an assessment that improves the value of your property. You are levied $2,500 to pay for sewer connections to your home. Because this levy is to improve your home, no deduction would be allowed. So if you happen to live in an area of town where there's no sewer system and everyone is on septic, and then the county or the city or the state decide to come in and install sewer lines and connect everyone's houses to sewer, typically they're going to charge a pretty hefty amount of money as an assessment against that property that the owner of the property is going to be required to pay. And that amount is, it could be thought of as a tax, but because it's for a benefit associated with that property, it will increase the value of the property, it is not deductible. We also have prorations. Proration of tax on purchase or sale of property is a pretty important thing and something I'm actively doing every tax season regularly. Because you can only claim a deduction for taxes assessed on property for the period of time you own it, you should review settlement statements for a tax proration between a buyer and a seller whenever there is a sale of a home or a purchase of a home. For example, tax proration is required in this situation. You bought a new home in October 2012, and then in November 2012, you received your annual property tax statement showing $2,000 as your July 2012 through June 2013 property tax levy. You will be the owner of your home for 9 months out of the 12 months in that assessment period. For the portion of the assessment period that you were not the owner, July, August, and September, you must prorate the deduction to include only the portion of tax actually assessed while you are the owner of the property. Assuming the assessed tax is paid in full before the end of the year, you could claim a deduction for 75% of the $2,000 payment that went out. In other words, $1,500. Well, that might seem a little unfair. You just paid $2,000 of tax, but you can only deduct 75% of it. What's up with that? Well, actually, it is accounted for at close when there is a purchase or a sale of a property going on. That title or escrow company that's closing the deal, part of their professional responsibility is to determine how much tax belongs or should be refunded or needs to be paid out at close to account for differences in when the payment on the tax is physically made, as opposed to the accrual period where it's assessed. So that's fancy words. Let's see what I mean by that. Illustration. The seller's part of property tax. In November of 2011, little Jimmy paid $2,592 of property taxes due on his home for an assessment period that runs from July 2011 through June 30, 2012. He deducted those taxes on his 2011 Schedule A when he filed his 2011 return. Then, on April 28, 2012, Bimbo and Betty Boop purchased that home from little Jimmy. And since the home sold partway through that July 1, 2011 through June 30, 2012 assessment period, the settlement statement for that sale shows that $453.25 is an adjustment item to the seller on line 107 of the settlement statement. How do you figure that number? Well, we go $2,592 of tax assessment divided by 366 days, multiplied by the 64 days that Jimmy is no longer the owner, and you get $453.25. That $453.25 represents the amount of tax assessed for the 64 days in the assessment period that fall after Jimmy sells his home. So since he claimed a deduction for that $453 in the earlier year when he filed his 2011 return, he's going to have a taxable refund. He's going to have to report that as income on his tax return. But the buyer, which is Bimbo and Betty Boop, that's an amount they have to pay. So when they come to close, Betty and Bimbo Boop are the buyers of the house. So you can see on the settlement statement we have the borrower, that's the buyer, and then on this column we have the seller. Well, in the buyer column it shows an adjustment for items paid by the seller in advance. Well, what this is telling you is that earlier, before this home sold to Betty and Bimbo, that little Jimmy paid these taxes. And now those need to be refunded to Jimmy. So Betty and Bimbo are going to give Jimmy $453 at close. It's all wrapped up in all of the other numbers they're paying at close. And when Jimmy files his return, he's going to have to report that $453 back into his income. And it is a deductible expense to Betty. They will get to deduct it because it's for the assessment period where they owned the house. So Jimmy has to include it in his income. Betty and Bimbo will get to deduct it because they are paying at the close of their home. They're reimbursing Jimmy for tax he paid, and essentially they're indirectly paying that tax themselves. So they would get to deduct it. But that's that particular scenario. Let's just suppose things went a little bit differently. Maybe Jimmy's one of those people who doesn't pay his entire tax bill for the entire year at one time. Maybe he pays it in installments. So assume the same facts except that little Jimmy decided to pay that 2011 through 12 property tax assessment in 3 equal installments. He made one payment in November of 2011. He made another payment in February of $864, and then he made a third payment in April just before he closed on the sale of the house. Because little Jimmy only paid 1/3 of the tax in 2011, his deduction for taxes claimed on 2011 Schedule A would have been $864, which means now that we're into the new year, figuring out what he paid for 12, we have to look at what was paid in 12. $1,728 is the balance that was due in 12. And of that $1,728, $453 is attributable to a period where he's not owner, so he can't deduct it. He will be allowed to deduct the difference, $1,275, and the buyer will be able to deduct the $453. So here we are with illustration number 3. The buyer's part of the property taxes. Bimbo and Betty Boop paid $453 as their buyer's share of property taxes on the purchase of their new home. And then in November 2012, they receive a property tax statement assessing taxes in the amount of $2,650. And that's for the period of July 1, 2012 through June 30, 2013, a period for which they will be full owners of that house. So they will be able to deduct on their Schedule A for 2012 the $453 they paid at close, as well as the $2,650 they pay in November for that assessment year. Real estate-related items that you cannot deduct. The following items are not deductible. Taxes for local benefits, itemized charges for services such as trash and garbage pickup fees, transfer taxes or stamp taxes that are typically paid on the sale of property, rent increases due to higher real estate taxes. The landlord comes along and says, I'm raising your rent because my taxes went up. Well, your rent went up, but you don't get to deduct the tax. and homeowner association charges are also not deductible. On Schedule A, some of those things could be deductible if you had a rental property or a business property, but on Schedule A for your personal home, no. Taxes for local benefits. Taxes assessed for local benefits and improvements that improve the value of your property are not deductible, and examples of local improvement assessments include street paving or improvements, sidewalks, water mains, sewer lines, public parking facilities, and similar improvements. You should increase the basis of your property by the amount of the assessment. Local benefits are deductible only if they are for maintenance, repair, or interest charges related to those benefits. If only a part of the tax is for maintenance, repair, or interest, you must be able to show the amount of that part to claim the deduction. If you cannot determine what part of the tax is for maintenance, repair, or interest, then none of it is deductible. And moving right along with the Schedule A, we're now on to line 7, which is where we enter deduction for personal property tax. Most states impose personal property tax on their cars. Oddly enough, Oregon, like it has no sales tax, also has no personal property tax, so that's an empty line every year here in our state. We don't ever have a number to put on there, typically for our clients, unless they came to Oregon from some other state where they did pay it. But most states do have a personal property tax, and you typically pay it when you register your car. Each year you have that annual renewal notice. You go in and you have to pay XYZ dollars to renew the license on the car, and at that time they'll look at the value of the car and charge you a tax based on that value you have in your car. And it's usually several $100s, even into the thousands of dollars, depending on the value of the car that you have, and you have to pay it each and every year that you register that vehicle or relicense that vehicle. Now, to be deductible, the personal property tax must be charged based on the personal property. It must be based only on the value of the property, and it must be charged on a yearly basis, even if it is collected more or less than once per year. The fees you pay for licensing or registration of your vehicle that are not based on the value of your vehicle are not deductible. Foreign income taxes, these, if you are going to claim them on Schedule A, are claimed on line 8. But foreign income taxes can be claimed in another way, and that is through the foreign tax credit, which is usually a much better deal. In addition, it could be the case that you excluded foreign income from taxation altogether under using the foreign earned income exclusion. So clearly, no double benefit. If you claim the foreign earned income exclusion, you cannot also claim an itemized deduction for foreign taxes paid on income that you excluded. And even if you didn't claim the foreign earned income exclusion, you may have claimed the foreign tax credit. And usually the foreign tax credit is a much better deal. If you claim the foreign tax credit, you cannot also claim an itemized deduction for that same foreign tax paid. But if you do not claim the foreign earned income exclusion, or you do not claim the foreign tax credit, then you are allowed to claim your taxes that you paid to a foreign government on Schedule A. And it's not even to say if you file 2555, you cannot put your tax deduction on Schedule A. It's that to the extent you excluded the income. So let's just suppose under the rules for the foreign earned income exclusion, you earned $100,000 of foreign wage. And using Form 2555, you were able to exclude half of that. But you paid foreign tax to the foreign nation of $10,000 on that $100,000. And since you excluded half the income under the foreign earned income exclusion, you would only be able to deduct half the taxes because you were able to exclude half the income. You're able to deduct only half of the tax that's assessed on the other remaining half of the income that is still taxed. It's a fairly kind of complex formula to figure it out. We do cover the foreign tax credit in our course called Federal Tax Credits for Individuals, and we also cover the foreign earned income exclusion in our course called Wage Investment Tip and Other Income. That is where we cover those two items. But the final little piece left over is if you do pay foreign tax to that foreign country, and it is deductible, you have a choice between the foreign tax credit and the deduction on Schedule A. If you choose to deduct it on Schedule A, you enter it on line 8. Now, even if you don't work overseas, so that you're not claiming the foreign earned income exclusion, it's also possible that you paid foreign tax without residing overseas. And you might have done that if you owned securities through direct stock ownership or through a mutual fund. And typically foreign tax payments will show up on those statements. And you can either claim the foreign tax credit for those or the itemized deduction, but not both. So where do you deduct taxes paid? Although you can deduct certain taxes that you paid on Schedule A, you may need to deduct a tax you paid on another form or schedule instead. And in deciding where to deduct a tax, you should consider whether that tax was a personal or a business expense that you paid. And this chart here helps summarize where stuff needs to go. If you paid a state and local income tax, that goes on Schedule A, line 5A. If you paid a state sales tax, that goes on Schedule A, line 5B. Foreign income taxes go on Schedule A, line 8, or on Form 1116. Real estate taxes are entered on Schedule A, line 6. Personal property taxes on Schedule A, line 7. But if you paid real estate and personal property taxes that are assessed on your rental property, you would enter those on Schedule E. And real estate and personal property taxes assessed on your business, if you were self-employed, go on Schedule C. If you paid self-employment tax, you are allowed to claim a deduction for the deductible part of that on Form 1040, line 27. And any other form of tax that you are allowed to deduct is entered on line 8 of Schedule A. Following is a list of taxes that are not deductible. These include fees and charges. Fees you pay for a driver's license or registration are not deductible. Transfer taxes. You cannot deduct taxes imposed on the transfer or sale of property such as your home or car. Federal income taxes, including Social Security and Medicare taxes, you cannot deduct those. However, the deductible part of self-employment tax is deductible as an adjustment to income on line 27 of your 1040, but never on Schedule A. Also, you are not allowed a deduction for fines or penalties for violation of the law, such as parking tickets, late payment penalties, or speeding tickets. And finally, licenses and fees, marriage, driver's license, dog license, none of those are deductible either. I see a question that's come up. Leslie asks, is there a limit to how many properties you own for deduction of real estate taxes? The answer is no. But if the real estate taxes are being paid on a rental property, then they go on the Schedule E. So where would you have taxes that are not on a rental property? Well, you could own your main home, and you could also own a second home, and maybe on top of that you own a piece of investment real estate, just empty land that you're holding for investment purposes. You would be allowed to deduct the property taxes you paid on all three of those, because the real estate is not income producing property, it's simply investment property. You would be allowed to deduct that there. But most of the time when people are paying real estate taxes on multiple properties, it's because they have rental properties. And if you are paying real estate tax on a rental property, that tax is entered on Schedule E. It is not entered on Schedule A.
Please pause the lecture video and complete this session's classwork. Enter your answers into the LMS when you have finished. Then resume the lecture for the classwork review.
So let's go through these. Question number 1. Mary is the non-custodial parent of Jeffrey. Jeffrey qualifies as a dependent and is in the custody of one or both parents for more than half the year. Mary paid a $500 medical bill for Jeffrey. Can she claim that expense? And as we covered in our class today, even though she's non-custodial, she is allowed to claim that expense, provided that the child Jeffrey was in the custody of one or both parents for more than half the year and that one of those parents is ultimately able to claim his exemption. Question number 2, Mr. and Mrs. H incurred medical expenses for their dependent child who died during the year. Mr. and Mrs. H paid the bills during 2012. Can they claim a deduction for this expense? The answer is yes, they can deduct the expense because the child was their dependent at the time that the medical expense was paid, or at least at the time the expense was incurred. And in his case, he meets both those tests. Moving on to question number 3, that was probably the most challenging for people. Jane incurred a medical bill in April of 2012, and then in October she married John. John paid Jane's medical bill for her in November. Jane and John will file separately. Who can claim the medical deduction on their return? Well, in this case, Jane didn't pay the bill. She can't claim a deduction for an expense she didn't pay. That's a fundamental rule when you're trying to claim deductions. John did pay the expense, and what did IRS have to say about that? Well, you're allowed to claim an expense for a person who is your spouse if you paid the expense after you were married, or if you file a joint return and you paid for them during the year. So in John's case, Jane incurred the medical bill in April. In October, she married John, and then in November, he paid it. He paid it after they were married, and that's why he can deduct it. And we compare that to question number 4, where it says, assume the same question as in 3, except that John paid that bill in June, before they got married, and then they file separately. Well, in that case, the answer is no, it wouldn't be deductible because they weren't married at the time he paid the bill, and they didn't file a joint return. So that's where 4 is out. Narwhal, Narwhal, narwhal.